Okay, good evening. This is Professor Mayer, and this is our sixth chat session. In this session, we're going to be beginning our discussion related to accounting changes and error correction. Today, what I want to do is I want to focus on some conceptual framework. Let's go ahead and jump into the material. So what we want to focus on today is looking at accounting changes and error correction from more of a theoretical perspective. We'll do a couple of problems, but what I really want to understand is to get you to understand the concepts related to what things that we're going to do retrospectively, what things we have to do prospectively. And we'll talk through this as we're going through the material and make sure that we're not commingling some of the issues. So when we think about accounting changes, make sure that we understand that we're talking about some very specific types of changes. So the first type of change is going to be a change in accounting principles. So a change from an accounting principle, say LIFO to FIFO, or going from average cost to LIFO or average cost to FIFO is what we would consider a change in accounting principles. So this is change from one generally accepted accounting principle to another, and we may be adopting a new standard, we may be changing, or we may be going, as an example, from a cost method to an equity method, or vice versa. So this is a change in accounting principle. Make sure we understand that as we're going through the discussion in terms of what we actually do with a change in principle. A change in estimate is simply where we have a piece or a transaction that we're making a new estimate on this. So as an example, let's say we have a depreciable asset and we at some point in time decide that the useful life is going to be greater or less. Let's say we are looking at the depreciation method and we're changing that. Some of these things are sort of usually related to depreciation type methods. So a change in the depreciation method, change in the estimated useful life, maybe change in the residue value, change in estimate for periods benefited by an intangible asset, a change in an actuarial estimate pertaining to a pension plan. So this is a change in an estimate. So what we're going to find, if it's a change in an estimate, we're simply going prospectively and we're not retrospectively changing anything. Change in reporting entity, changing from, let's say we acquire a new company and we're now doing consolidated statements. So consolidated subsidiary not previously included, we report the consolidated financial statement as opposed to individual statements. This is what we would consider to be a change in estimate. So as we're going through the changes, keep in mind that there's three types of changes. Changes in the principle, changes in estimates, and change in the reporting entity. Then when we're talking about correction of errors, we need to understand that a correction of an error is different as compared to these changes. A correction of an error is caused by a transaction being recorded incorrectly or not at all. There may be mathematical mistakes. There may be inaccurate physical inventory counts, a change from a cash basis of accounting to accrual, failure to record an adjusting entry, recording an asset as an expense, or vice versa. So these first items are changes or essentially corrections that we're making because we made a mistake. But included in this is going to be fraud, where we're actually correcting fraud in our financial statement. But what you'll see is that basically what we're looking at is we're looking at doing it basically the same way. Disclosures are going to be different, but the focus is going to be in the correction of an error is we have to go retrospectively in terms of capturing the error and doing something with this depending upon what the circumstances are. So we're going to, again, go through the conceptual ideas today, and then we will go through a couple of problems, but next week, or in 2 weeks when we go through this, is we're going to focus on some very specific problems, and the more problems that we do, the more ability that we'll have in terms of understanding what's actually taking place. So when we're looking at changes and error correction, so this slide relates to everything that we're talking about, is we need to understand that in some cases we're going to be a retrospective approach, there's going to be a retrospective approach, and in other cases there's going to be a prospective approach. Retrospective means that we go back and restate the financial statements, or at least make changes in the retained earnings. In a prospective approach, essentially what we're doing is we're not doing anything to what we already have. We're only making the changes and going forward. So prospective means going forward, retrospective means going back. And again, in the retrospective is the previous years are revisited. They're revised. The statements are made to appear as if newly adopted accounting methods have been applied all along. And then there's a journal entry that creates an adjustment to all these accounting balances that are affected. So let's talk initially about the change in accounting principle. So again, change from one generally accepted accounting principle to another. So we are talking about GAAP to GAAP. We're not talking about non-GAAP to GAAP. We're talking GAAP to GAAP. The accounting choices once made should be consistent year to year. Changes in circumstances may make a new approach more appropriate. And one of the issues related to a change in accounting principle is, even though we are maintaining GAAP, we need to understand that maintaining GAAP is only a part of it. What we are concerned with from this perspective is the comparability. So if we're comparing this year to last year, but last year we used the LIFO and this year we're using FIFO, well, we don't really have that comparability. And that's why we need to address this from a very specific perspective. A switch by hundreds of companies from LIFO to FIFO in the mid-70s, for example, was a result of heightened inflation. Changes within a specific industry, or changes that might be mandated when FASB codifies a new standard. Changes are made in response to circumstances. Changes are made because a specific industry is moving that direction, and then changes sometimes are made because we have to make these changes because FASB has actually changed things. We need to consider this on the effect of management compensation, existing debt agreements, and union negotiation. Each can affect management selective of the accounting method. Keep in mind that when we are looking at bank loans as an example, there may be various restrictions on these bank loans that may prohibit changes, or may, with the change, is we may not be maintaining a certain ratio based upon the covenants. So we need to understand this. And we certainly need to understand that management should not be receiving a bonus because the accounting method has actually been changed and it reflects a higher earnings for them, where they did nothing other than the fact that make that accounting change. So we need to understand that the accounting change actually does have an effect on a lot of things. We need to understand the implication of these issues as we are moving forward. Financial analysts must be aware that the different accounting methods used by the firm and within the same firm complicates comparison. Investors and creditors must not consider only the effect of comparability, but possible hidden motivation for making the changes. So we need to understand changes sometimes are made, and the decisions based upon these change is not necessarily based upon what's best for the organization. There may be ulterior motivation. Managements tend to prefer to report earnings that follow a regular, smooth trend from year to year. The desire is not always to move the direction higher or lower within the income statement. Voluntary changes in accounting principles are reported retrospectively. Changes in the principles changes in principles, we're looking at these retrospectively. And the reason we're looking at these retrospectively is because we are attempting to provide a comparability related to the financial statements that would not be there if we did not do this retrospectively. So what you see here in this example, and again, we'll go through some other specific examples in our next discussion in 2 weeks, but this just gives you a basis for what it is that we're looking at. So Air Parts Incorporated used LIFO inventory method at the beginning of 2016. Air Parts decides to change to the FIFO method. Income comparisons for the 2016 and prior years are as follows. So what we see here is that the cost of goods sold under FIFO is actually less. There's a difference in terms of cost of goods sold that's going to impact the net income for the organization. And then within that 3-year period, there is a $300 difference in the comparison between LIFO and FIFO. Air Parts has paid dividends of $40 million each year beginning in 2009. Its income rate is 40%. Retained earnings was $700 million. Inventory was $500 million as of January 1st, 2014. What we're doing is we are looking at this as if we actually were using the FIFO method for the 3-year period. And again, what we are attempting to do is we're attempting to make this change in 2016 from LIFO to FIFO. What we're looking at here is our net income for the 3-year period under the change. Air Parts makes this change as if the newly adopted accounting has been applied all along. So what we need to understand is that this change is going to affect the balances, the beginning and ending balances of inventory, and certainly we're going to have income tax implications in terms of assets and liabilities depending upon what direction the change goes. Looking at this change, again, what we have is we have the difference of $300 going from the LIFO method to the FIFO method. 60 of those dollars are in the current year. So what we're concerned with is the two items, 2014 and 2015, where we were reporting LIFO, but now we are retrospectively going back and re-reporting this as FIFO. What we're looking at here is our cost of goods sold. The cumulative effect of the cost of goods sold is impacted by $300. Our income taxes has an impact of $120. And what we have is net income and retained earnings. The impact is $180. Comparative balance sheets then would report 2014 inventory at $345 million higher than it was reported in the prior period. Likewise, 2015 would be increased by 400,000. 2016 by 460 that it would have been had the LIFO switch not occurred. So what we're looking at here is we're looking at the implications for this 3-year period, and the issue becomes is why are we using these 3 years? Well, we're using these 3 years because these are the 3 years that are being reported in terms of the comparative balance sheet. What we see here in terms of the retained earnings is that ultimately we are going to have to revise the retained earnings based upon the implications of moving from the LIFO to FIFO. We adjust our cost of goods sold. This is the change. So the pre-2014 adjustment is $300 million. In 2014, we have a $45 million adjustment. 2015, we have a $55 million. So what we're attempting to do here is we are making an adjustment of $400 million. We're increasing inventory by $400 million to the beginning of 2016, where 2016 we are now using FIFO. But what we have to do is we have an adjustment to retained earnings, and then we create an income tax payable specifically related to this, because this essentially is increasing our net income and increasing our income tax. We haven't paid it yet, so we've got to create the income tax payable. So what we're looking at here is the pre-2014 adjustment. We're looking at 2014, 2015, and what we're attempting to do is the beginning retained earnings of 2016 for 2016 needs to be adjusted so that we can then move forward with the new accounting method. Disclosure notes be provided in the first set of financial statements after the change to justify the application of the new method. So we are looking for the justification, and in the disclosures is we are explaining why the change was made, point out that comparative information has been revised, and report any per share amounts affected for the current period and all prior periods presented. So you notice that what we did in this is we identified pre-2014. Why is 2014 important? Well, 2014, 15, and 16 are the 3 years that are presented in the comparative financial statements. But clearly there were implications prior to 2014, so that's the $300 million. What we're doing here is we're making the change so that retained earnings as of January 1st, 2016 is reflective of what's actually taking place. So this is a journal entry that resets everything. 2014, we're good to go and we're ready to go there. So a quick question here. Big merchandiser changed from the FIFO method of inventory to the weighted average method when reporting 2016 comparative financial statements. The 2015 inventory would be, and the answer here I'll just go ahead and give it just for sake of clarity, is it's going to increase or decrease depending upon how prices change during 2016. So we're not necessarily saying that changing from FIFO to LIFO is going to move it one direction or the other. We just don't know until we understand how prices have actually changed. When a retrospective application is impractical, we simply go forward with this. We don't go back. Sometimes a lack of information makes it impractical to report a change retrospectively, so the new method is simply applied prospectively. This gives an illustration of just going prospectively in this change. I won't read the notes here, but you got the information, so you get an idea that this change actually may take place. This is an interesting question. We haven't really talked about this, but I just want to point this out. This might be something that you might see in a CPA exam. A change in accounting principle that usually should not be reported by revising financial statements of prior period is a change from the weighted average method to the LIFO. Changes to LIFO are handled prospectively. So just put that in the back of your mind. If we're changing to LIFO, we're simply going forward with the change and not going back. If a new accounting standard forces us to make a change, then what are we going to do? If a new accounting standard specifically requires prospective accounting, the requirement is followed. For example, a change in the equity method to another method of accounting for long-term investments, GAAP, required prospective application of the new method. So when we went to equity method, we did not restate everything. We simply went forward with this. Now what we're looking at, so we're changing directions. Just make sure we understand this. We're changing directions, and now what we're looking at is we're looking at a change in estimates. Change in estimates is changing, again, useful life, depreciation period, the method of depreciation, primarily focusing really on depreciation. What we're doing here is we're doing prospective. We are not retrospectively making the change. Disclosure notes should describe the effect of the change on income from continuing shares for the current period, but we're not going retrospectively. This is an example of a note to the disclosure. talking specifically about warranty expense, that we made the change. We did not go retrospectively. And essentially, this journal entry is simply the warranty expense for that period. We're not at all concerned with what took place in the prior period. Universal Semiconductor warranty expense was 2%. After review, they determined that 3% was more realistic. The effective income tax rate was 40%. The after-tax effect of the change was $1.8 million. Assuming 100 million outstanding shares, the effect is described as follows. So what it's saying is we made this change in an estimate. It's significant to the financial statements, and it has an effect of 1.8 cents per share. Depreciation methods is also considered a change that we're doing prospectively. Universal Semiconductor switched from some of the year depreciation to a straight line. The change affected its precision equipment purchased at the beginning of 2014 at a cost of $63 million. The machines had an expected useful life of 5 years and an estimated residue value of $3 million. Some of the year calculation is what we see here. So this is 2013, 14, and 15, but what we're talking about is 2016. Is all we're doing is we're finding the undepreciated amount as of January 1st, 2016, saying, okay, well, it's going to be good for 3 years. The residue value is $3. So going forward, the depreciation is going to be $8 million, as opposed to what we had in the prior 2 years. What we're doing is with depreciation, changing in the depreciation method, changing in the estimate, is we get a starting point. Starting point is our cost minus the accumulated depreciation, and then we just go forward with it. And going forward with it means that our depreciation expense changes. So you notice this is simply the depreciation expense, $8 million depreciation expense, accumulated depreciation. That's all we're concerned with. Which of the following is not a change in accounting principle usually accounted for retrospectively revising prior statements? And what you see here, changing, so you notice the last 3 items, FIFO to average cost to FIFO, LIFO to FIFO. These are all changes in accounting principle. The first item is a change in a estimate, what we're calling an estimate, changing from some of the year to the double declining balance. So the answer is A. And what we're looking at here is change in depreciation methods are changes in estimates and accounted for prospectively. So we are not going retrospectively related to these changes. A prospective approach is usually required for a change in reporting entity, a change in estimate, a change in accounting principle, or a change in error. And what we're looking at is we're looking at a change in estimate. The idea is that a change in estimate is we're simply getting a new starting point, and that new starting point, if it's depreciation, is the cost minus accumulated depreciation. So that's the depreciable value. We determine the residue life, the useful life, the residue value, determine what method we're using, and then calculate it going forward. And we're not making any consideration for what took place in prior periods. So we're not restating anything. Lamont Communications has amortized a patent on a straight line basis since it was acquired on 2013 at a cost of $50 million. During 2016, management decided that the benefit from the patent would be received over a total period of 8 years rather than the 20-year legal life being used to amortize the cost. Lamont's 2016 financial statements should include a patent balance of $50 million, patent amortization expense of $2.5 million, $5 million, or a patent balance of $34 million. So let's kind of look through this. So what we're looking at is Straight line, for $50 million. It was being amortized over a 20-year period. Now we are a couple years later, and we're now going to reduce this significantly to just 8 years. What we're looking at here is we're looking at a balance here of $34 million. Looking through the calculation, accumulated amortization at the end of 2013 was $16 million, comprising a 3-year amortization of $2.5 million per year, so it's $50 million divided by 20, plus 1-year amortization of $8.5 million. We get that by taking the unamortized portion and dividing this over 5 years. So what we have is at the end of this period is $34 million. So we've talked about the changes. So we've talked about the changes from the perspective of changes the accounting principles. We've talked about changes related to estimates. Now what we want to focus on are changes specifically related to the correction of an error. So we're going to have to change things, but this is a correction of an error as opposed to anything else. So an error correction is caused by a transaction being reported incorrectly or not reported at all. Previous year financial statements are retrospectively restated. So when we are correcting an error, we are retrospectively going through this. So the illustration that we have here, we are looking retrospectively, accounting principles, changes in reporting entities, correction of error. And then you notice in the blue at the bottom is prospectively, changes in estimates including changes in depreciation method, changes in accounting principles when retrospective application is impractical, and changes in accounting principles when prospective application is mandated. So there are certain things that we're going to go prospectively, and there are certain things that we're going to go retrospectively. The correction of an error is one of these items that we go retrospectively. Looking here, what we're doing, this actually is a good slide that you want to consider, is when we're looking at changes in principles, we are disclosing, we're doing an adjustment that affects the balance to the new method, the adjustment to retained earnings at the earliest year reported. So essentially is we are making the change related to, here what we're saying is reported to the earliest year reported. The changes in estimates including depreciation changes, we are not restating, we are not doing a cumulative amount. There is no prior period adjustment in the journal entry, but we are disclosing. In our changes in reporting entity, this is retrospective. We are restating prior periods items. There is no cumulative effect that's being reported. The journal entry involves consolidating the financial statements, and this is something that you discuss in your advanced accounting class. And then what we're talking about now is errors. We are doing this retrospectively. There is a restatement. This is clearly going to be disclosed. We are doing a cumulative effect, an adjustment to retained earnings of the earliest year reported, and we are correcting any balances that are incorrect as a result of the error. So let's look at the correction of an error. And this is a very specific process that we're going through in terms of this change. So the first step is a journal entry is made to correct any account balances that are incorrect as a result of an error. Previous financial statements that were incorrect as a result of the error are retrospectively restated to reflect the correct amount for all years reported for comparative purposes. If retained earnings in one of the accounts is incorrect as a result of the error, the correction is reported as a prior period adjustment to the beginning balance in a statement of shareholder equity or a statement of retained earnings if that's where it's being presented. A disclosure should be included to describe the nature and the effect and the impact on income. So let's look at an example. So in this example here, what we're looking at is we have 2 years of information. We have statement of retained earnings, beginning balance, net income, dividends, balance at the end of the year. So we see 2014 ends with 600,000 and 2015 begins with 600,000. Statement of retained earnings in 2015 and 16 with a corrected balance. What we see here is that we corrected 2015. The correct balance is $580,000. Net income 400. We subtract less dividends 200, so the balance at the end of the year is 780. That 780 moves over to the next year, then we go forward. So you notice that the correction was in 2015. And the correction was a prior period adjustment. So the error correction illustration, we learned the process needs to be analyzed whenever an error is encountered. Is it significantly more complicated to deal with if the error, it is significantly more complicated to deal with if the error affects net income in the reporting period which it occurred, and it is not discovered until a later period. Let's look at this case here. So G. Little paid $3 million for the replacement of computers and recorded the expenditure as a maintenance expense. The error was discovered a week later. So in this case, what we're doing is we correct the error and then we replace it. So you notice that it was done in the same week. The issue obviously is what happens when it's in another period, which is what we're going to talk about next. So error correction, this is actually Barnes & Noble. And again, won't read through this, but it talks about a restatement of a prior period. Let's go through a couple of these questions here. Which of the following is not true regarding the correction of an error? A journal entry is made to correct any account balances that are incorrect. Prior year's financial statements are restated to reflect the correction of the error. The correction is reported prospectively. Previous financial statements are not revised. And D, a disclosure should not describe the nature of the error and the impact of its correction on net income, income before extraordinary items, and earnings per share. So if you look through this, and the key is which is not true. What is not true here is that we're just reporting prospectively. We're doing a disclosure note. We are restating prior financial statements, and we are making a journal entry specifically related to this. The effect of an error is reported as an adjustment to the beginning balance of retained earnings, and prior year financial statements are restated. Let's look at this, and this is a situation where there is an error that was identified and it affects the prior financial statements. So what we're looking at here, and it doesn't affect net income, but what it's looking at here is it's looking at notes receivable versus accounts receivable. So MDS Transportation recorded $2 million notes receivable as accounts receivable. This was discovered a year later. Correct the error. So we debit notes receivable, credit accounts receivable. When reported for comparative purposes, in the current year's annual report, last year's balance sheet would be restated to report the note should have been reported as a note in the prior period. So we're essentially restating last year, making that correct, and stating it correct this year. So that's a simple situation. MDS incorrectly reported the $2 million note. Since last year's net income was not affected, the balance in retained earnings was not incorrect, so no prior period adjustment to the account is necessary. A disclosure note would describe the nature of the error, but there would be no impact on net income, income from continuing operations, and earnings per share. So again, just make sure we understand, we've talked about the correction of an error. If the correction of an error is identified within the period, we simply correct the error, life goes on. If it's a correction of an error that affects balance sheet items but doesn't affect the income statement item, the idea is it's not going to affect retained earnings, so we simply make the change. We restate the prior period as part of our financial statements because it's being reported as in the financial statements, and then we make a note in the disclosure. It has no effect on earnings per share and net income. Now what we're looking at is errors affecting prior year's net income. Most errors affect net income. When they do, they affect the balance sheet as well as income statement. Both statements must be retrospectively restated. The statement of cash flow is sometimes affected too, so it may be cash flow from operations when it should be cash flow from financing, as an example. Incorrect account balances must be corrected. Income taxes are affected by income errors. Amend income taxes are prepared either to pay additional taxes or to claim a tax refund for taxes that are overpaid. What we're looking at here, in 2016, internal auditors discovered that Seidman had debited an expense account for $7 million of cost of sorting equipment purchased at the beginning of 2014. So you notice that this was a transaction in 2014, but it was reported in 2016. Let's just kind of think about the implications here. So the $7 million that we paid in 2014, we expensed $7 million there, but in fact, this should have been a capital item that was depreciated. So there would be depreciation expense that would impact 2014, 15, and 16. You notice also that this is equipment. So as opposed to being a cash outflow from operations, this is going to be a cash flow item for investing. So this actually has implications for all three financial statements. So what we're looking at here, this is what should have been reported, is $7 million for equipment, credit the cash, $7 million. And in 2014 and 2015, the expense related to depreciation and a credit to accumulated depreciation. So you notice how the asset item has implications of a depreciable asset. The income statement has implications because we no longer have this expense, and we also have a depreciation expense, and then of course cash flow is going to be affected because this is not a cash flow from operating activity but a cash flow from investing. So what was reported is our depreciation was understated for the 2-year period by $2.8 million, and our total expenses was overstated by $7 million, so that net income was overstated by $4.2 million. So keep in mind that we overstated expenses on one end of 7, understated it for the 2-year period, again, to the beginning of 2016, which is our current year, which has been the identified year. There is a $4.2 million implication to retained earnings without consideration for income tax. For step 1 is we're going to correct this. So the correcting of this in 2016, this is when we identified this, is we debit equipment, we credit accumulated depreciation for the 2 years prior to 2016, credit retained earnings. What we're doing here is 2014 and 2015 that were incorrect as a result of this error are retrospectively restated to report the equipment acquired and to reflect the correct amounts in depreciation and accumulated depreciation. Both statements are reported again for comparative purposes in 2016. So these internal auditors identified the $7 million item. So in 2016, beginning retained earning balance, we have a prior period adjustment of $4.2 million. In 2015, we have a prior period adjustment of $5.6 million. 2014, no adjustment would be necessary for that period because the error did not occur in 2014. The disclosure would be related to the nature of the disclosure and the impact on continuing operations. And the effect of most of the errors are different, depends on whether the error was discovered. If the error in our illustration is not discovered until 2019 or after, no correcting entry would be made because this was a self-correcting error. The item would be fully depreciated and we would not be concerned with it at that point. Let's go through a couple conceptual points here and then we'll call it a night. In 2016, it was discovered that Heinz 55 had debited expense for the full cost of an asset on January 1st, 2013. The cost was $24 million with no expected residue value. Its useful life was 5 years. The correcting entry, assuming the error was discovered in 2016, before the adjusting entries include, what we're looking for here is we're looking for the adjustment. We need to take away the expense, but we also need to add the depreciation. Accumulated depreciation would be credited for the 3-year period. Depreciation for 2013 would be accounted for normally. In addition, the asset would be debited for $24 million and retained earnings would be credited for 9.6. What we're going to be doing in our next session in 2 weeks is going through some very specific problems and questions and so forth related to all of these issues. But I thought that in this first lecture is that we use this time in terms of providing a good framework for the material as we're going forward. I think we basically have understood this, so we understand what type of changes can take place, whether there's change in principal, change in estimate, change in reporting entity. We also understand that there are reporting of the errors. Each of these we need to consider whether they should be prospective, meaning going forward, or retrospective, meaning coming back. And if we understand these concepts, then I think we're going to be fine. So I thank you very much for your time and attention, and we will continue this discussion in 2 weeks, okay? Okay, thank you very much. Everyone have a great night. Thank you.